In this video, I'm giving you the full breakdown of claiming Social Security at 62 versus 67 versus 70, what each age actually pays, and why this decision works differently once a household has $2 million or more. And lastly, answers to the three most important questions for a family with $2 million or more. 3 decades of walking wealthy families through this decision, and the standard advice fails them the same way every single time. It treats the choice as a bet on how long you're going to live. For a household with $2 million, the claiming date is tied to your withdrawal plan, your tax picture, and your spouse's future income. And that's why I'm making this video today. I'm going to talk about what each age really pays, why the popular analysis misses what matters for a household of your size, and the 3 questions that I walk every single family through. So let's get right into it. Your earnings record is the wage history Social Security has kept on you every year you worked, and your benefit is calculated off the highest 35 years. That number's already set. The only thing left to decide is when you start collecting it. If you file at 62, maybe the benefit's $2,200 a month. If you wait till 67, that same record pays $3,140. If you wait till 70, it pays $3,890. This could be the same person, same work history. That's $1,690 a month between filing at 62 and filing at 70, which is a little over $20,000 a year. And then there's the cost of living adjustment, which is a percentage of whatever your benefit happens to be. So the larger the check gets that larger raise every single year. You see, 67 is full retirement age for most people retiring today. And the whole formula is built around that. Filing before it reduces your benefit permanently. And at 62, that reduction is about 30%. Filing after it increases your benefit permanently at 8% a year. And the increases stop the month you turn 70. You see, those numbers were not picked arbitrarily. They were calculated so a person who lives an average lifespan collects roughly the same total either way. That's what we call actuarially neutral. See, the design is built on averages, but I don't know about you, but I don't feel very average. There's also a 4th number in this decision. It does not appear on your Social Security statement, and no calculator online will ask you for it. You see, for a married couple, it matters more than all 3 ages put together, and I'm going to come back to it in a minute. You see, that 8% is not an investment return. It's guaranteed by the federal government. It's adjusted for inflation every single year, and it's paid for the rest of your life. As an investment advisor, as a retirement planner, I cannot promise a family all 3 of those within a portfolio. That 30% you give up at 62 is still gone at 90, which is usually when the check matters most. And each of these ages buys a different sized permanent income floor, and that floor decides how much work your portfolio has to do. My name is Chris McClure. I've been a financial advisor for 31 years, and I put these videos together about once a week. And hopefully it's good information for high net worth families who have worked too hard to leave money on the table. Back to Social Security. Most people researching this end up looking at a break-even chart. And it usually has 2 lines. One line is filing at 62. It starts sooner and it pays less. And then waiting until 70 starts later and it pays more. The crossing point has real math behind it. 62 to 70 is about 96 months. And at 2,200 or so, the early filer banks about $211,000 before the one who waited collects a dime. And after that, the gap is $1,690 a month. And it takes about 125 of those months to catch up. That's how the chart gets you to age 80. See, you're supposed to conclude that if you die before 80, you should have filed early. And if you live past it, you should have waited. You see, the math is accurate, but it rests on one assumption. That assumption is that the benefit is the only thing in play. At $2 million or more, that assumption does not hold. At $4 million, it holds even less. And at $10 million, it's not true at all. Look at what it has to be true for that chart to answer your question. Every dollar of the benefit gets spent the month it arrives. So there's no portfolio beside it. There's no tax return and there's no spouse because the chart follows one life and then it stops. For a family with $200,000 saved, that's close enough to be true. It's fine. The benefit is the plan. At $2 million, the benefit is one piece inside a much larger income structure. And when you move it, everything else moves with it. The more useful question, in my opinion, is what the claiming age controls. And it controls 3 things that appear nowhere on the chart. It controls the size of your permanent income floor, the shape of your taxable income through your 60s, and what your spouse lives on. See, that's the 3 questions: longevity, taxes, and the survivor. So the first question is longevity, and the break-even chart, at least it tries to answer it, but unfortunately it still gets it wrong because the question was never how long you're going to live. For a married couple, it's how long the money has to last for two people. You see, take a couple at age 65 today. His life expectancy is around 82 and hers is around 85. Those are the numbers that families typically plan around. But roughly 1 in 4 65-year-old men live past 90. And for the two of them, it's basically 50-50. It's very likely that one of them will still be around at age 90. You see, that changes what delaying is. It's not a wager on living a long time. It's insurance against the one outcome that actually costs you money, which is living a very long time. If you reach 92 and that 3890 has been arriving every month for 22 years, growing with inflation the whole way, that adds up to be real money. And you see, health concerns change this answer. And I'm not going to pretend otherwise. A family with a genuine medical reason to doubt whether they have decades in front of them, they really have good reason to file at 62. Maybe they have cancer in their family, or maybe they have heart issues in their family. It makes sense, file at 62. So I always ask directly, I talk about family history on both sides, what their parents died of, how old they were. You see, the analysis splits between single people and married couples. If you're the higher earner in a marriage, your claiming decision is not primarily about your own lifespan. When one spouse dies, the survivor keeps the larger of the two benefits. So the higher earner's benefit is the one that continues after either death. A higher earner in average health, married to a healthy spouse several years younger, often has a strong case for waiting even if his own life expectancy would not justify it. The lower earner's calculation is different because that smaller benefit ends at the first death regardless. That combination is very common. Yvonne and Gordon are a good example. She's 66 and she's a retired airline captain, and she was the higher earner by a wide margin, and she waited till 70. He's 63 and filed at 63 for about $1,100 a month. See, his benefit covers parts of their spending now. Hers keeps growing, and whichever of them lives longer has the largest protected benefit that those two records can produce. So I'd like to take a quick pause here. If you're approaching this decision and nobody's run the full analysis for your household, for both records, both timelines, all three questions, go ahead and click the link below to book a call. This is exactly the type of work that I do. The single decision can often cost families hundreds of thousands of dollars in retirement. So now on to question 2, and this is the one that the break-even chart has never heard of. The second question is taxes, right? So we talked about longevity, now we're going to talk about taxes. Taxes, it begins with a window most people do not know they have. It's the years between the day they stop working and the day they turn on Social Security. And it's usually the lowest income years that a wealthy household will ever see again. No salary, no required distributions, because those don't start until 73. So you really control what shows up on your tax return. Filing at 62 fills those years with benefit income. The smaller check for life is not the only cost, unfortunately. You also spent the cheapest tax years you were ever going to have, and that cost, it doesn't show up on that break-even chart. So what those years are really useful for is a Roth conversion, which is simpler than it sounds. A conversion is moving money out of a traditional IRA or 401k into a Roth and paying the income tax on it. You don't withdraw money for spending. You're changing which account the money lives in and settling the tax bill early at a rate that you pick. After that, it's never taxed again, not for you or for your kids. A conversion is taxed as ordinary income, and that's why it's so important to do it in the low years. Convert while your income's down and you're filling that 12% bracket and the 22% bracket. If you wait until 73 with Social Security running and required distributions coming out, that same conversion is taxed at 24 or 32%. $150,000 a year for 5 years is $750,000 that is moved. Inside the window, the tax on that runs around $150,000. After 73, it's north of $200,000. So you saved $50,000 or $60,000 for the same dollars moved on a different date. And there's a second layer of tax, which is how the benefit itself gets taxed. Up to 85% of your Social Security becomes taxable once your income crosses certain thresholds. And I want to be precise about this and how it applies to you. Those thresholds come from a 1993 tax law. Above $34,000 for a single filer, $44,000 for a couple. And they have never been adjusted for inflation. A household with $2 million is over them every year without trying. And you may have heard that there was a recent law passed where there is no Social Security taxes anymore. What passed in 2025 was a temporary deduction for people over 65 that phases out above $150,000 for a couple. So a couple at $150,000 get little or none of it. And those thresholds didn't change. This is also why delaying to 70 so often pairs with spending portfolio money through your 60s as opposed to Social Security money. You're trading withdrawals from your investment accounts now for a larger permanent floor later. We talked about longevity. We talked about taxes. The third question is the one couples almost never raise on their own. And after 30 years, I would tell you it matters more than the other two together. You see, when one spouse dies, the household's two benefits become one. The survivor keeps the larger and the smaller one stops. It doesn't transfer, it does not get reduced, it just ends. At the same time, the tax situation changes. The survivor now filing single taxpayer on close to the same portfolio income with a standard deduction about half the size and narrower brackets. So less money coming in, a larger share going to tax, and it's also the worst year of your life because you just lost your spouse. That's just horrible planning. That's why the higher earner's filing date matters so much. Whatever that person files for becomes the amount the survivor lives on. And it gets decided decades before anyone needs it. So let me talk about a couple I'm working with right now. Wayne is 69 and his wife Joyce is 64. He managed a construction firm and she was a secretary at an insurance company. And between them, they built $2.5 million on two salaries that never made anyone rich. Wayne filed at 62, not because they needed the money, they didn't need a dollar of it. He was 62, he was eligible, and he was just glad to have it. He filed for himself online at the kitchen table on a weekday afternoon. And Joyce was sitting right next to him. His benefit came in at $2,200 a month. Joyce's own record pays her $1,300, and that was 7 years ago. In all 7 of those years, nobody had ever explained to either of them what that filing date does to her. You see, this is the fourth number. When Wayne dies, Joyce keeps his $2,200 because it is larger of the two, and her own $1,300 stops. So that's $15,000 or so out of her income. In that same year, she begins filing as a single taxpayer on nearly the same portfolio she's living on. If you run it the other way, if he had waited until 70, the benefit she inherits would be $3,890 instead of $2,200, almost $1,700 more a month for what could be 25 years of her life, with the cost of living adjustments applied to the larger figure the whole time. You see, she's also 5 years younger than he is. Unfortunately, I've sat with widows on both sides of this. Eileen's husband died a few weeks after he retired, and she has lived on his early number ever since. And there's nothing to fix after the fact because the filing date is the filing date. So that's the 3 questions: the longevity issue, how long the money has to last, the taxes, and the survivor. Let's put them together into the actual decision because you now have every piece the break-even chart was missing. There's 2 things you can do right now this month that cost you nothing. Pull both benefit statements and put all 6 numbers on one page because most people have never seen that page. Then have the conversation about health, family history, and what the income looks like on one benefit instead of 2. You see, Wayne's story is not over. He was disappointed that he made the wrong decision, but now there is a 12-month window after you file in which you can withdraw the claim. You can repay what you collected and start over as though it never happened. That closed for him 6 years ago. You see, but he's 69, not 70. Once you're past full retirement age, you can suspend your benefit and earn delayed credits for every month it stays suspended, right up to age 70. So he has about a year of that available. It permanently increases his benefit, and because Joyce inherits that benefit, it permanently raises her floor with it. See, that's what planning is all about. That's what we're trying to do. It's not much, but that's what we have left. If you haven't filed yet and all 3 of those numbers are still available to you, that means you have the one thing Wayne didn't, which is the whole decision still left in front of you. So now you've seen what each claiming age actually pays, why the break-even chart fails a household with $2 million, and the 3 questions that decide this: how long the money has to last, the taxes, and what happens to the survivor. You see, this was never a bet on your own lifespan. It's an income design decision, and it always was. If you'd like the full 3-question analysis run on your family's real numbers, click the link below, book a call with me, and I'd be happy to run through this with you. I really enjoy making these videos. I hope you enjoyed it, and I'll see you on the next one.